Good morning, everyone. Thank you for joining us for this quarterly market roundup. We're going to be talking about what happened in Q4 2020, and it's on this snowy, blizzardy morning on the East Coast. But we're inside. I've got my tea. We're going to make the best of it. Uh, you know, I would be remiss by not starting this by saying a very happy birthday to my co-host this morning, Shweta Lawande. She could be anywhere in the world, but you chose to be here with us on your birthday, and we appreciate that.
I'm so happy to be here. I can't imagine wanting to be anywhere else on the morning of my birthday. So thank you for having me.
Look at that dedication, folks. Rain, sleet, snow, birthday, doesn't matter. Shweta is here to give you the information that you are looking for, and we appreciate that. So we are your experts. I like that term, experts. I'm glad they put that in there. I am Devon Barrett. I'm a CFP, CFA here at Francis, one of the advisors here at Francis Financial. I have been with the team coming up on 7 years. Time flies when you're having fun. And I'm with my super talented colleague and also teammate, Shweta Lawande. Happy to have you, Shweta.
Thanks, Devon. It's almost as of this week going to be 5 years that I've been on the team. So
Can't
I
believe
don't know
that.
where the time goes, but it's been great.
It's funny because that feels like so long, but then I also can't really remember that much time without you. So I'm in a weird time warp when it comes to how long you've been with the team. But yeah, I believe it. Happy almost anniversary too. You got a lot of celebrating to
Thank you.
do
I know
in
it's
February.
going to be a fun week at the virtual office this week. So I'm very excited.
A lot of Zoom celebrations in store for us, folks. Great. So, as we mentioned today, we're going to be recapping a few things. We'll be talking about the market performance, what happened in the stock market, the various stock markets, in an action-packed fourth quarter of 2020. We'll be walking you through the news. What were the major headlines that we saw in the time frame? What really moved the needle as far as what was going on? What can we expect? That we'll even blend into a little bit of what's going on right now, since we are still in the early stages of the first quarter. And then we'll talk about some behavioral financing. Like what should I be doing? What these things that I should be considering where we are in the marketplace. And then we'll talk about some of the fun stuff that we have going on at Francis Financial. And then if there's any questions that we can answer, we'll take some time to carve that out to answer those questions as well. So we've got an action-packed agenda this morning. We're looking forward to jumping in. But without further ado, I'll kick it to Shweta. You want to talk about what happened in the stock market last quarter?
Absolutely. So this certainly goes without saying, but 2020 was dominated by COVID-19. First, in the beginning of the year, as the WHO declared the disease to be a pandemic, and then later in the following months, as we all over the world grappled with the growing number of cases and the restrictions that we were putting in place to slow the spread of the disease. But as you can see on this chart, despite the persistence of COVID, we saw largely positive returns across equity markets for 2020. And a lot of this growth was driven towards the end of the year as investors felt a lot of enthusiasm around the rollout of a vaccine and what that could mean for the economy if lockdown restrictions could be lifted all around the world. And in fact, just in the US itself, after a 34% drop in mid-March, the S&P still closed up about 16% for the year. And this rebound is certainly impressive considering where we started off earlier this year, but the growth is still uneven. And what that means is we're seeing the majority of this enthusiasm being intensified around large tech companies. So not every sector in the market is feeling this warmth from investors right now, but it's certainly helping the overall stock market and the returns that investors are seeing. And we're still seeing actually optimism across the board from investors surrounding what could be an advanced timetable for the reopening of the country and the world at large based on anticipated herd immunity. And if we could achieve that faster than we had originally planned, that makes investors feel good about putting their money in the market. And when we see that happen, we see growth in the market like this. And if we dive further into what we're seeing in the US stock market, what this graph in particular is showing us is that investors are paying a premium to hold US growth company stocks compared to US value company stocks. And this is a trend that we saw for several years now, and it's continuing into this year. So, based on what's known as their PE ratios, investors are willing to pay more for each dollar of earnings per share reported from a growth company than they are for dollars earned by value companies. And as we navigate the months ahead, what our expectation is that investors will start to close this gap between growth and value stocks to take advantage of a recovery on the value side of the market and take some of their profits that they earned on the growth side. And it may seem intuitive to many people that the top two performing sectors for 2020 were online retail and information technology. Of course, everyone, including myself, maybe especially myself, turned to online shopping and delivery for all of my necessary items. And a large portion, including the staff of Francis Financial, were forced to work from home for the majority of the year. And conversely, the worst performers were sectors that will require some sort of reopening to return to profitability. So, hospitality and hotels or office buildings and airline travel are some of the ones that were hurt the most.
And I know sure that my packages were piling up at the door faster than I can open them. So this goes to show that yeah, it is pretty intuitive what's going on out there.
Absolutely. And what's interesting is if we turn our sights out of the US and take a look at what's going on in the international space, by some metrics, international stocks are trading at a discount compared to US stocks. And historically, what we've seen for the past few years is that international stocks have been lagging behind the US for quite some time. And we can't say for certain that all of a sudden they'll begin performing better and start to close that gap in value. But what this relative difference in valuations tells us is that international stocks are becoming more attractive to investors. And especially as we see international countries, China, for example, recovering at a rate much faster than we're seeing in the US, they're becoming that much more of an attractive space for investors during this time. And I'm sure, Devon, you have more to share about this later on in our presentation.
I do. I like that cliffhanger you've left the audience on.
This is just a preview. There's more to come. And actually, with that, why don't we turn to some of the news items that we want to share?
So, like many other presentations that we've done this year, COVID-19 continues to be the major headline, unfortunately, for what is controlling our lives, what's gripping our economy, and what is impacting the stock market. Where we are right now, luckily we're in, I would say, personally, a better place than we were at the last time we did this presentation. But we are still, as you all know, we're still in the grips of it here in the United States. Just in the next slide, you'll see the numbers. But as of 12/31, when we did this presentation, we had crossed over 400,000 deaths and about 24 million cases. And unfortunately, those numbers are only climbing. Now we're closer to 450,000 deaths. As we were preparing for this presentation, I saw the stat that someone in the United States is dying every 30 seconds from COVID-19.
Oh, wow.
And that is just absolutely astounding. Astounding to think about. So, the backdrop of this whole real presentation as far as looking forward and what we can expect is going to be how long does it take us to return back to a sense of normalcy, and what does the new normal even look like? So that was a question that the market was trying to settle into in the fourth quarter. So, at this point, it's no surprise, and we can actually go one more slide. At this point, it's no surprise that the market had a really strong quarter. Shweta just walked you through that on Q4, so I'm not saying anything groundbreaking. But the reason for that, there were a couple of things that were at play. One, and I would be remiss if I didn't take the opportunity to put this dad joke out there, but I would say, so to speak, the shot in the arm for the stock market was the vaccine rollout. Right now it hasn't been distributed as quickly as maybe some would like. I know there are issues with people trying to get vaccinated that want to. Right now we're averaging about 1 million vaccine shots a week. Positive, we're going in the right direction. But the market is always forward looking. So the stock market prices and valuations are not based on where we are right now. It's based on where we think that we will be in the future. And then this strong performance we saw in Q4 was centered around the announcement of the vaccine and this hope that it really bolted into the market that we will get back to a place that that looks familiar to us sooner rather than later. And even though we mentioned the cases are rising and deaths are rising too, fortunately, knock on wood, over the last 2 weeks or so, we've really started to take a step back as far as the number of cases. I think we saw that spike over the holiday. We did see that holiday surge that experts were warning us about. And then now, luckily, in most states, I know here in New York, over the last 2 weeks, cases are actually down about 33%, which is solid. We're going in the right direction. And hopefully with the vaccine and the number of people that have already had COVID-19, we can reach kind of a herd immunity. The thought process is later this year. And that's what the market is really banking on, that we will get to a place where people are comfortable going back out, going to travel, going to the theater or to a game. And that'll really bring our economy back up to a place. And that's actually, to some optimism, as Shweta mentioned, something that we're seeing in China. China has really rebounded much more quickly than other areas, in the sense that they have returned. Like manufacturing industry specifically was hit really hard in China, and now it's fully recovered after the pandemic. So they are a little bit more familiar with dealing with pandemics than we are, and it shows. So that is the hope, that they will be the example of how we can continue to improve our economy as well. But as I mentioned, the market's really rallied around this idea that we will get back to normal sooner rather than later. And there was also a change of administration in the quarter, big election cycle that really dominated our news and our headlines. It wasn't even the quarter. It felt like it dominated our headlines. I can't even remember when we weren't talking about politics, but essentially it was as you all remember, it was a very contested, tense election. But it did, despite some shocking actions by many at the Capitol, it was a relatively peaceful transfer of power. That was something that the market was banking on. Market doesn't like uncertainty. So all of this, the election, all these challenges and the election was stolen talk wasn't something that the market likes to hear. So when we settle back into a norm, whether that's a Democratic president or Republican president, the market just likes to know what it's dealing with. And that's the case. That's what we got here. Once we've moved into the new administration, it did put once Biden was elected and we saw that there wasn't going to be a grand, re-election or anything like that, the market did settle down a bit. And that was also some of the performance that we've seen could be attributed to that sense of calm that was restored into the market. And then there was the blue wave, which in reality wasn't so much a blue wave. It was more like a gentle blue tide coming ashore, because it was really 50-50. Right now, the Senate is split 50-50. And the reason that we say Democrats have full control is because as the Democratic president, Democrats maintain control of the House. And while the Senate is split 50-50, tiebreaker is the vice president. In this case, it's the Democratic Vice President Harris. So that is why we say Democrats have full control. And the reason I say it's not really a blue wave, it's a blue tide, is because when it's 50-50 like that, the assumption is that there will be more moderate Democrats. They may not just agree with anything that's passed. So that's why you can't really say it's a full wave that Democrats are going to just be able to wash through and pass whatever they like. This situation is a little bit more unique and a little bit more nuanced in the sense that it is still 50-50. And we can see how that comes into play in a minute as I walk you through some of the other major headlines that popped up in the quarter. Tax implications, tax time. This was a big one in the quarter, and it still remains a big question mark out there. But before I get into some of the tax changes, I would really caution our listeners to try to predict what the tax changes are going to be. We know that there are going to be tax changes. That's not a secret. Biden has laid out his proposal in a 110-page document that we've all seen. And I'll walk through some of the highlights that showed there. But again, as I mentioned, what makes this really interesting is that we assume that all Democrats will vote with to propose the plan the way it was, or to, excuse me, to pass the plan the way it was proposed, but that may not be the case. So the plan that was outlined, and this is something we commonly see in politics, that a proposal will be outlined and then it will not pass in the same iteration that we thought because of opposition from the other party. So I personally think that this is something that we'll see this time around, but just to give you a reminder and a refresher, we could talk about what the plan really looked like in the way it was intended to be passed. And I think the big one that is that taxes are going to increase. Biden has proposed increasing taxes. The highest tax bracket is going to be closer to 40% at the federal level, up from 37% now. But the key here that Biden really wanted to emphasize was that President Biden, excuse me, let me put the respect on his name that it deserves. President Biden wanted to emphasize was that this is kicks in for income above 400,000. I think that was something that personally got lost in the political shuffle, that it was like, oh, taxes are raising for everyone. This will remain to be seen what the new brackets look like, but there is a heavy emphasis on increasing taxes for those making over 400,000. And that actually trickles down into capital gains as well. That was another contentious point, that the capital gains rate right now. So capital gains is taxed at a really favorable rate, 15 to 20% at the federal level, depending on where your income falls. And then short-term capital gains are, so if you sell something, if you buy a stock, sell it within a year, you pay what's called short-term capital gains tax. And that short-term capital gains tax is taxed at ordinary income rates, which is like as if you got money in your paycheck. It's your tax rate. So to deter people from doing that, we have what's called long-term capital gains rates, which is the more favorable one. So if you wait over that year period, let's say you sell it 1 year and 1 day, you get that more favorable treatment on the gain. Biden is proposing for individuals making over $1 million. I want to emphasize that because that's something that to me gets lost in the shuffle. Over $1 million, that long-term capital gains rate is gone. It would be taxed at short-term or ordinary income rates across the board. And again, this is one of the ways that President Biden wants to generate revenue to kind of support some of these programs that he's outlined in his proposal that he read on his platform. The estate tax, this is a big one. There's a couple of things at play here. One is that, well, what is the exemption going to be? I think that was a real question that the market and many individuals had. Right now, there's what's called the estate tax exemption, that an estate under a certain amount doesn't pay estate tax. And estate tax can be pretty high. President Biden is proposing that it goes up to 45%. And essentially the exemption right now is a bit over 11 million per person. So a couple essentially that has an estate less than 22 million, you're not really looking at an estate tax. This was increased in the Tax Cut Job Act of 2017. And before that, the exemption was about 5 million and change. Right now, we're not really sure where the estate exemption is going to go. The general consensus is that it'll be back to where it was in 2017 or 2016. That remains to be seen, but that will be a significant issue for some of those larger estates that have done some planning with the assumption that the exemption would be 11 million. Another big one that impacts a much wider array of Americans is the what's called the step up in basis. So a basis is essentially, to make it simple, what you've paid for something. So let's say you bought Apple stock at the IPO, you bought $100,000 worth in 1980, good for you. And then now it's worth well over, let's say it's worth $1 million for simplicity. You go to sell that, you pay capital gains tax on that 900,000. The exemption and the exception to this rule is that at death, if I pass that Apple stock to my heirs, then instead of that $100,000 basis that I had, they get a step up to whatever it's worth at my death. So what does that do? Essentially, if you inherit a stock or a piece of property or whatever it is and sell it right away, you're probably not going to pay any tax on it because it's increased to the level that it was at my death. So there's not going to be a gain for you to pay tax on. This saves a ton of money in taxes for the individual anytime that there's a death. President Biden is proposing getting rid of the step up in basis to try to tax some of these estates, to try to track some of the transfer of money on death and generate some more tax revenue, again, for these plans that he's proposed. So this is a big one. This is a big one that if it's passed in the way that we think it's going to be passed, tax planning changes a bit because right now, you would never really want to, those deathbed gifts that you see in movies and on TV, that stops my heart as a financial advisor, because that is a really bad tax situation where if you wait, then you don't pay taxes. Now that goes away, so it makes the estate planning arena very interesting. Corporate tax is another big one. Uh, President Biden is proposing to raise the corporate tax rate to 28%. Right now, it's 21% via the Tax Cut Job Act, with a 15% minimum for tax for large corporations. So what does that mean? 15% minimum. I hope I'm not revealing the curtain right now, but companies are really good at avoiding taxes. Not necessarily avoiding in the sense that they're really good at lowering their tax liability through different deductions and different losses that they're showing on the books, different accounting wizardry. And many times, I think this is something that you see every once in a while. There's some outrage about how little in taxes many companies pay, and that's because of the different deductions that they're able to take advantage of. And so President Biden is proposing that, regardless of all the great wizardry and the great accounting department that you have, certain corporations that are of a certain size would have to pay a 15% minimum regardless. And then the 28% is actually, it's higher than we're dealing with right now, but it's actually not it's nowhere near the highest that we've seen. And in fact, the average corporate tax rate over the last 100 or so years is closer to 32%. So this is not really pushing us into uncharted territory. I know that's a big question that investors have. Well, what is this new higher corporate tax rate? How is that going to come into play for stocks? Because stocks are based on earnings in a large portion. And if they're paying more in taxes, if companies are paying more in taxes, what happens to their earnings? Again, my personal opinion on this is companies will find a way to have earnings and to mitigate their taxes as much as they can. They've done it for years and years and years. And again, this is just going back to where we were in 2016. And that wasn't even the highest we've been. So this isn't, again, our uncharted territory that we're going into. It's not a wild, wild west scenario. It's, more the norm of what we've seen over the last couple of decades. The U.S. economy. Unfortunately, the U.S. economy is disconnected from the stock market, and stock market and the U.S. economy are not one and the same. That's I think stock market or economics 101, and I think that's become really a stark example of it right now, in the sense that we're seeing great market performance for 2020, but many are hurting the economy. You can see it in our jobs reports, which are getting better but are not great. You can see it, just many households are hurting. And if you go to the next slide, Trey, you can see that many, as far as the unemployment rate, it's getting better, but look at that spike. Look at that spike, the pandemic. We got up to 15.3% at one point. That's astounding. That's astounding. And it's many of the jobs that, it's hospitality, it's many in the travel industry, it's retail. And I think that's a real big reason as to why this pandemic and this recession, quote unquote, hasn't really been equal. You can see that certain jobs were just lost, while other jobs really transitioned into the Corona economy pretty easily. As Shweta mentioned in the beginning of this, we've been on Zoom since day one. Many people have transitioned to Zoom since day one. So their jobs haven't really been impacted, while others have just been either completely lost their work, or it's a stop, start as restrictions are imposed, released. And something that we can see, as I mentioned, the recession is not equal for a couple of reasons. One, it's savings. Savings has really been a big issue. I saw a stat as I was preparing for this. It's, the top 40% of households in America during this pandemic have increased their savings. The top 20% pretty drastically, but the top 40% as a whole. And the reason for that is, one, the top 40% is still working. As I mentioned, those jobs transition pretty well. And then also their expenses have come down in a lot of cases, because those with more disposable income tend to use it on things like travel, like dining out, things that we aren't really able to do as freely as we were right now. So that money is going directly into savings. Whereas the bottom 60% of Americans on average have been the ones that have been more impacted as far as their work. And so that, they've lost income, and then they've actually eaten through their savings and the federal stimulus that we've seen, unfortunately. So it has really been the tale of two economies right now. And then unfortunately, this trickles down into any demographic, men versus women. Women have been hit harder by this pandemic. people of color have been hit harder. And I know you just recently spoke to a press outlet about this. You want to provide some color?
I did. And, what's disheartening to see is that women of color, partially because of their presence in industries such as hospitality and food service, they're being hit the hardest. And for many of us, that's not surprising because even before the pandemic, there existed this gap or this inequality between the opportunities that we were being presented to men and women. And what's also interesting for the women who were able to keep their jobs during this time, we're seeing dads getting promoted in their remote jobs more often than moms are. So it's
Hmm.
it's a continuation of a problem that existed before the pandemic, and it's we're sad to see, I guess, how the pandemic has intensified some of these inequalities.
Wow. Wow. Thank you. And I mentioned that Shweta did a press outlet for that, and I should say the name. It's CNBC. We put that prestige on it. So check that out. But yes, as we mentioned, it's been really stark, the differences, unfortunately, that we've seen. So the recovery has been the impact has been unequal. The recovery has been unequal. So it just goes to show, hopefully, we can get back to a semblance of normalcy sooner rather than later to try to help address that inequality that's only gotten wider from this pandemic. And then stimulus. This is another one that goes back to my disclaimer in the beginning of, what is presented is not always what's passed. So I will say there's a lot at play in this proposal. So in President Biden's proposal, it's $1.9 trillion stimulus package, which sounds like a lot, but in the grand scheme, it's not. It is a lot. Let me not downplay that number, but it's not unprecedented for what has been pumped into fighting the coronavirus thus far. We've seen stimulus of this level throughout the last year or so. So what President Biden is proposing is another round of stimulus checks, or stimmies, as the kids on the internet like to call it, of $1,400, $600. So the thought process was $2,000. You got $600 before at the end of the Trump administration. Now I'll give you the other $1,400 now. That's what gets you to the $2,000. Extending unemployment benefits. That's set to expire in March. President Biden is proposing to add an additional $400 a week and continuing that through, I believe, end of October, I believe is what the proposal is right now. We'll see what comes up. Then a big portion of it is partial out to aid for states and local governments as far as distributing the vaccine. This has been something that's been pushed right now onto the states. The previous administration was like, you know what, this isn't going to be a federal thing. This is going to be on the state level. It's been to mixed results. So that is something that's going to be more coordinated as far as aiding local state governments, and then vaccinations and testing programs as well. And another big portion of it is going to reopening schools and then funding schools that are underfunded, in a sense that, even though we're 9 months into the pandemic now, not all schools have the equipment and have, even us with our technology that we had issues with this Zoom. So imagine kids in underfunded areas trying to learn. That's something that needs to be addressed, and it's been proposed. We did this presentation, obviously ahead of time over the weekend. I know you guys have maybe seen that there's already been pushback. Republican officials have proposed $600 billion. So that is a far cry from the $1.9 trillion that President Biden is trying to get passed. So that, again, is a perfect example of you never know what's actually going to get passed. So we'll see. Obviously, my opinion is the way negotiations work, we're not going to see either of those. We're not going to see 600, we're not going to see 1.9 trillion. So we'll fall somewhere in the middle. Where actually we fall remains to be seen. It's a developing story. So what does all this mean? It means that we're poised for a pretty volatile 6 to 12 months. This is nothing new. We had a volatile last year. March, the first or the second quarter was crazy. We saw, March 23rd was the trough, so to speak. We were down over 30%. Then markets recovered. Then third quarter was up and down, and then the fourth quarter was strong. We'll probably see the same thing going forward. There are analysts that think 2021 is going to be a good year for the stock market for a couple of reasons that we have outlined. The thought process of the vaccine rolling us back to normal sooner rather than later. It's the thought process that China is going to lead the way as far as the global economy, as far as that recovery. I'm personally not going to go on record and make a prediction. Did that in the end of 2019. I said 2020 was going to be a great year. And it was for the stock market, but obviously for a lot of reasons, it wasn't a great year. So in the wise words of former President George W. Bush, fool me, you can't get fooled again. So I'm not going to make any predictions. I think the general takeaway is that it's going to be choppy waters. So expect days like we saw on Friday when market was down 2%, coupled with a couple days earlier when market was up almost 2%. We're going to see those days. So buckle up. And I think Shweta, you can talk about I think how we can maybe navigate those waters because it's tough a lot of the time.
Absolutely. And I can't think of a better year than 2020 that illustrates just how little control we have over the market. And I read something very interesting recently, and it was a fellow advisor who said, smart investing has less to do with what actually happens in the market and more to do with how we as investors react to what we see happening in the market. And for the disciplined investor who's looking for long-term returns, there are some tools that you can use in any kind of market environment to make sure that you're on track to for your portfolio to grow in the way that you want it to grow. So first and foremost, and this isn't the first time some of you may have heard us talk about this, and it won't be the last because diversification is so important for any investor of any age with any number of goals, because it is simply impossible to predict how any one area of the market will perform in the future. So on this chart, which looks more like a beautiful mosaic than anything else, each color actually represents a sector of the global market. And in each of these years, the sectors are ranked from best to least performing. So the random splattering of coloring goes to show that no one sector of the market does well more than 1 year in a row. And so it's unwise for us as advisors and investors to predict how they will move over time. So one of the best tools we have to capture long-term growth is to diversify the investments in your portfolio. Another tool that we have to bolster our long-term growth is to stay invested in the market. Even in the face of changes in administration, long-term investors win just by staying invested. So in this chart, what we're seeing is the hypothetical growth of wealth for an investor who would have put in $100 in the S&P 500 index back in 1926. And the red portions here represent time periods when a Republican president was in office, and the blue portions represent times when a Democratic president was in office. And we can see just on this trajectory that both parties have contributed to the significant growth that we've seen over time. And there isn't a pattern of stronger returns when any one party is in office. So markets have historically continued to provide positive returns over the long run, irrespective of which party occupies the Oval Office. So for investors who panicked during the election, regardless of which side they were rooting for, some of them, if they chose to pull out of the market at that time, would have missed out on some tremendous growth in the market. So staying invested for long-term investors is certainly the way to go.
That's a great point, Shweta, and it brings me to one of the interesting stats that I read. I'm the stats guy. For anyone who doesn't know, I love statistics. It was interesting statistic about what happens when a singular party has control of full government. So like we have right now, full Democratic control. And dating back the last, I think 60 years or so, when Democrats had full control, the stock market performance was 14.6%. And when Republicans had full control of the government, the stock market performance was, drumroll please, 14.6%. So that's a coincidence, but to me, it's a very interesting coincidence that it goes to show that regardless of which party had full control of government, it was the exact same performance. So I think it really underlines what you were just saying about, the stock market's going to do what it's going to do based on many factors, not just who is in power at the time.
Absolutely. And even to time the changes in an administration, people who chose to change their portfolios before election results were announced, during, because for some last year it was almost a week or so where the results were being announced, and even after, it's impossible to time, even if you're certain that the market is going to move one way or the other. So the best course of action is just to stick with your plan, stick with the mix of stocks and bonds that you've decided is the most appropriate for you and what you're trying to achieve with your portfolio, and to not make any changes based on what you expect will happen in the market. And that's exactly what this chart shows us, that since 1926, the US stock market has rewarded long-term investors with an average annual return of about 10% each year. Now, of course, we can't say what's going to happen in the future. And so it's very important to remember that in any given year, returns may be sky high, they might be extremely poor, or they might be somewhere in between. But what's absolutely clear is that the stock market rewards disciplined investors who stick with their plan and ride out the inevitable ups and downs.
Great segue. It's almost like you knew what fly was coming next.
Great. And with that, we wanted to share some upcoming events. You know, Francis Financial always has events going on, and just because we are in a pandemic, that doesn't mean that they've stopped. We've just moved over to Zoom, like we are doing for this presentation. So I'll let Devon
Yes.
talk about some things that are coming up.
Awesome, thank you. So we have another webinar coming up. It's going to be market calendars for May 3rd, 2021 at 8 a.m. Our counterparts, Natalie and Alexandra, are going to be presenting it. They're going to do a fantastic job. I think we've raised the bar pretty high, but you know, I'm sure they'll exceed. And then also, you know, financial fitness is great, but we're also big on physical fitness as well. Health is wealth. So that's why we do our Zoom workouts on Thursdays at 5:30. The February 4th, we have yoga. So every other week, our own Deborah Donnerfeld leads us through yoga. February 4th is her birthday, so we may skip this one. You know, we may give her the day off. We'll see how that goes. But then at the very least, February 11th, with Dr. Laura Miranda, Strengthen and Tone. She does great workouts. We used to do them in person every other week. And then they've transitioned to Zoom seamlessly. So if you haven't done it, please get on there. Fantastic. So that, like I said, we'll be doing something every week, whether it's Deborah's yoga or Laura's fitness class. So check it out. With that, questions. Please feel free to shoot us an email with questions. We did have one. Unfortunately, she had to leave to get for work for a meeting, but I will read the question anyway. So when she watches the presentation, she knows we didn't ignore. Did I see something about international stocks not performing as well in 2021? It was essentially based on, you know, the COVID impact and what does that landscape look like was the question. It's a great question. And it's, again, I don't want to get into the making predictions arena because my track record is iffy. But the thought process from analysts is that 2021 will be a positive year across the market for a few reasons. One, I mentioned it's recovery, the assumed recovery from COVID. Another one is I alluded to it, that people are saving a lot of money right now, at least the top portion, and that tends to be investors. So there's a lot of cash on the sidelines that people think will get deployed as markets calm down a bit, as things get back to normal, and that will drive up prices. Just the influx of money the way supply and demand works will drive money up. Will drive prices up. And then the other thought process is that China, as I mentioned earlier in the presentation, has recovered pretty well and pretty seamlessly thus far, knock on wood, from the pandemic. And China is a huge player in the global economy. It's not a secret. You know, we are a big market mover. China's a big market mover. And so China's continued positive or perceived for positive performance for this year would help kind of rising tides lift all boats. That's the thought process. There are obviously question marks out there. One big one is Europe, how they're in a similar boat to us as far as where they are with starting and stopping restrictions and dealing with the pandemic. They've also got some political changes going on in a few areas. Brexit is something that's continually evolving. Also, Germany has a big election coming up. And Germany's a huge player in the Eurozone. So there are factors out there. So, you know, all to say, don't try to time the market. We don't know what sector is going to do well at what time. So, you know, all things remain to be seen, but just stay calm, stay the course, trust your allocation, your mix of stocks and bonds, and then what happens will happen. And that was the only question we had. Great. So thank you everyone for joining us. Again, Shweta, happy birthday. Thank you for taking the time out
Thank
on
you.
the day of your birth and walking us through this great presentation. Everyone stay warm, stay dry. If you have to go outside, be safe because it's pretty nasty out there, at least on the East Coast. So, hopefully I get outside, have a little snowball fight later. Why not reconnect with my youth? But with that, thank you for attending. And we look forward to seeing you and speaking with you soon.